billahi minash shaitanir rajim. Bismillahir rahmanir rahim. As we begin today, greetings traders. It is I, Abdul Shabazz. This is Some Real Change, Stock Options Trading Journey. And today, this terrific Tuesday that we are upon right now. Should I get my plans together? Getting my plans together. So grateful for the opportunity to do what we love. Big shout out to those of you who watch the replay. We can't thank you enough for tuning in to the replay. Big shout out to those of you who trade with us every day. We thank you for doing that. We are here. We got a little late start today, but we are here. It's great because it's giving you guys the opportunity to see how I put my plans together. I will be making some plans today. Scratch. Making some new plans today. Very interested. 695, 8. All right, here we go. We got some delayed reports coming out today, nothing big. Okay. Back to this. See what I like. I don't like any of this for the SPY today. Let's pull it back a little bit more. We get below that 693.5. I like a put below that. 693.5 on the 694 put. $692 profit target. $692 profit target. Second profit target, 691. That's what I like for the call. I mean for the put. 694 put, 693.5 entry, 692 first profit target, 690, really 697, 690.7 area. For the second profit target, so that's what I like there for that. So that will look like here. That'll be there. That's what that'll look like. And come there with it. Okay. That's what I would like to see there. For a call. I don't know for a call. I don't know for a call. I don't have anything for a call. Worked out yesterday beautifully to the 694, but that's all I could see. I couldn't see past the 694. Even yesterday. So today I really don't have anything past that 694 for the call side. So I don't see a reason to buy right now. Pretty much in the state of indecision. Todd, good morning, Todd. For me to want to take a put, I gotta see something like that. That's what I'll be looking for a put. Let's see how that works over into the larger chart. Just for the call, there's just so much, it's still overhead resistance at the 696. So you really have to possibly look above that 696 for a call. I don't see it right now. I don't see it. So I do not have a plan for a call today. If you have one, Todd, let me know, but I don't have a plan for a call. I do not see a good reason for a call. All right, let's turn that over to this chart here. With yesterday's action as well. Said I like that 693.5 area for a put. It's going to be right here. Set an alarm there just to alert me. Just a lot of sideways action. It really could eliminate pre-market. For real, for real. Let's go ahead and do that immediately. Get rid of pre-market. So we do not have pre-market up right now. Just want to show yesterday, a little bit of Friday. Ooh. Beautiful. Green hammer right out the gate. Googity Bob. That's what you get for being late. Missed that. It's a beautiful setup. It's early. A beautiful put. See if it's sustainable. Beautiful put. Reset that alarm. First 5 minutes very volatile. First 15 minutes can trick you. Might be thinking the market is going one way and go back in another direction. Brother Jared, good morning, my brother. Be looking for a phone call from me, Jared, real soon. Nothing going on right now today. Market has really been in a state of indecisiveness, hanging in the same area. Just a lot of uncertainty going on right now, and that's okay. Not going to rush anything. Okay. Bulls do have control of this week coming into today. Even though today is starting off as a bearish day, Bulls do have control of the week, so we do want to keep that in mind as well. Do not have pre-market up on the 5-minute chart. We do not have pre-market up. Pre-market was pretty flat. Finding a base at the 693.2. Coming back to retest that here shortly. Love it. Alrighty. And that second 15-minute candle now for you ORB traders. And you can just pretty much see that we just simply had some sideways action. Beautiful move to the 695 down to the 694. We just been bouncing back in that area. Looking for either a break to the downside below that 693.2 or a break to the upside above the 696. In between that, being very cautious, being very safe, looking for a clear setup. Without one, we will not trade. Looking for that obvious trade. Yes, sir. $9.48, $9.48. I want to see what that 10 o'clock candle is looking like today. Very excited to be here. I want to thank you guys for coming in and hitting the like button on your way in.
first regular, every 6 months that goes on is another $1.30 a share of dilution of Warner Brothers shareholders. Our ticking fee, we've got so much certainty and conviction around our regulatory trajectory that we're going to go the opposite way. We'll pay Warner Brothers shareholders if we don't get, that approval in an expedited time frame like we believe we will. So,
right.
It's very clear that at the end of the day, this is about Warner Brothers shareholders, and they will ultimately be the ones that make a decision on what delivers the best value.
And by the way, though, I could imagine a scenario under which if they don't think they're going to get the vote of their shareholders to approve the Netflix deal, they do go back to Netflix and say you're going to have to pay more, and Netflix does it. It's hard to imagine in some ways that Netflix would have come this far, Jerry, and not be willing to go up another buck or two. I don't know. And I wonder what you guys would do in that scenario.
Well, remember, under Delaware law, it's not just the value and certainty now, but the conversations and engagement that could lead to a superior offer. So with everything that we have done, there is absolutely no reason for the Warner Brothers board not to engage with us to determine and to satisfy their Revlon duties.
Right, and so you indicate what? Does Larry Ellison actually have more money to put into this thing? By the way, I should point out Redbird and Ellison have gone up in your equity contribution as a result of the $2.8 billion termination fee you're making very clear you're going to pay. So you're at some $43.6 billion. Is there more money behind that, or are you guys out?
I keep saying it, these numbers get thrown around, and I always point out to people, even on my side, that there's a B there, not an M. Right? This is the largest private equity raise in history, and I think it speaks for itself. So, I'm still waiting for anybody to come back and say that our offer is inferior from a value or certainty standpoint. I'm still waiting for that. That has never been raised. What's been raised is taking a trust that's been around, since 1988 and making it irrevocable versus revocable, asking for a personal guarantee from Larry, paying the breakup fee. We've done all of that. Okay, so there's no more balls to hide. There's no more things to hide behind. There's no reason for the board not to engage with us to determine indeed what we're saying is true.
Walaikum assalam, brother Hamza in the building.
Certainly a possibility given
what you thinking about this, Hamza?
Concerns. You go into a vote. Do you feel like you have what you need to actually win that vote? Which, by the way, I shouldn't describe it.
I'm on standby.
Simply having Warner Brothers shareholders say no to Netflix. It doesn't necessarily imply they're going to come back to you even and say, okay, we'll deal with you. But do you feel like you're in a position to win that argument now?
Hold right now.
You're a Warner Brothers shareholder.
What you thinking, bro?
What is the value of the Netflix deal? What's the answer to that question? Is it $27.75? Is it 21? Is it 23? There is a Pac-Man. There is a gobbling up of Warner Brothers shareholder equity here that SpinCo
and it's
enables.
an important point for you to be making. I've tried to make it because it's somewhat complex. That said, the more debt you take off of global networks, the more you enhance its own value in the public markets. And you're just taking from one side and putting to another, but it's the value of the overall. So, can I make an argument with less debt it's going to be worth more?
Yeah, but Warner Brothers, at the end of the day, Warner Brothers shareholders care about the cash to them, and under the Netflix deal, it's just studio and streaming. It is a contained system, right? But right now, even in their own proxy filing, their DCF on this declining set of assets independently traded is 72 cents. Okay, so somewhere in here, you remember when this whole thing started and people were saying it was $5 a share? Then it went down to $3 a share. Now it's down. Now there's a low end of 72 cents. Right now, based on
just open up the charts, okay, brother.
$17 billion of debt they have on it.
Yes, sir.
Yeah, it's negative equity.
I'm just seeing a lot of sideways action right now.
What is the value of the deal?
When you get a chance.
It's a good question. You continue to ask it.
I know how busy you get sometimes, but if you get a chance, put your eyes on it.
Certified, basically
let me know what you're thinking, but I'm just seeing some sideways chop right now.
So the 10-day
so I'm just
clock
looking for
is ticking now,
a clear setup on the higher time frame,
the
15, preferably the 30.
Compliance with the DOJ's second request that opens a 10-day period for them to complete their diligence. And once that's satisfied, then you have the pathway towards ultimate approval. And so it's a very important milestone. We've also, received clearance from the foreign investment authorities in Germany. So there's a progression here of just showing a pathway towards the things that we've said on the certainty front and the regulatory front.
All right. Well, if it doesn't work out, Versant is trading at less than 4 times free cash flow, Jerry. Just pointing it out there, you know.
Right.
To be continued. Certainly appreciate your taking time, Jerry. Thank you, Jerry Cardinal, of course, founder, CIO of Redbird.
You bet. Thanks, David.
Meantime, pretty nice open here. Most sectors are higher. Dow did get it to a record of almost 50,465, let's say. Maybe the only fly in the ointment this morning, Mike, is communication services. That's mostly Alphabet.
Yeah, Alphabet's giving back, some of the outperformance it's had for a little while. And, it's the broadening, it's the equal weight trade that is working. It's particularly rate sensitive. Treasury yields down. Things like housing related are strong today. I was also going to point out the Bitcoin decline. Now it's hovering around these levels. That chart looks a lot like software.
Yeah, we're going to get to what Michael Saylor said on Squawk this morning about Bitcoin. Strategy's down about 3, and Bitcoin's close to the lowest levels of the week. When we come back, an exclusive with Coke's James Quincy on earnings and the consumer as he gets ready to pass the CEO baton.
Tuesday morning. Welcome to Squawk on the Street. I'm Sarah Eisen with Carl Quintanilla and David Faber. We are live as always from Post 9 of the New York Stock Exchange. Coming up this hour, 2 big earnings interviews you won't want to miss. We will speak exclusively with Coca-Cola CEO James Quincy as that stock dips after missing revenue estimates for the first time in 5 years, though it has recovered nicely. Plus, Marriott CEO Tony Capuano is with us as that stock jumps. The hotel name posting some weakness in North America, countered by strength in luxury and international. And we'll talk with Evercore's Julian Emanuel about Alphabet's 100-year bond offering and what he says that signals about the health of the overall market.
Been a busy morning for economic data. Getting some more right now. Let's get to Rick Santelli. Hey, Rick.
Hey, good morning, Carl. Indeed, these are our November reads, so fourth quarter for business inventories. Expected to be up 0.2%, comes in a little light, up 0.1%. That would be the lightest business inventory build going back to August of last year when it was unchanged. We had back-to-back months of up 0.3, which was just revised. October now stands at up 0.2. The positive numbers, of course, are holding GDP. Any kind of negative inventory numbers would subtract for that. And we are all monitoring growth, of course, to try to bring down some of those deficit to GDP numbers. Sarah, back to you.
Okay, thank you, Rick. Let's get into all the earnings. Coca-Cola shares falling, but off the lows after reporting a modest growth outlook for the year ahead. The company missing revenue expectations for the first time in 5 years. Water, sports, coffee, and tea all outperforming the rest of the portfolio for the quarter. Let's bring in CEO James Quincy, his final earnings interview as CEO before Enrique Braun steps into the role on March 31st. I'm going to miss it, James. Thank you for joining us.
Yeah, no problem. You're welcome.
We'll talk about the succession in just a moment. Just first on the quarter, you know, you had conditioned investors to do beats. We haven't seen a revenue miss like this in quite a while. What happened?
I think there were a couple of atypical things that happened in the fourth quarter around some of the business mix, the finished goods of our bottling businesses that caused a negative price mix in the fourth quarter. It was very atypical, and as I always encourage investors to take an average full quarter view of that variable, because it produces some anomalous effects occasionally, which it did in the fourth quarter. But when you read through that, what you see is underlying strength in the revenue, 1% volume growth, which is relatively strong in consumer products these days, 4% pricing, so 5% revenue. We're confident we've got momentum going into 2026. So a weird anomaly, but underlying strong growth in the revenue and testament to everything that people are doing across the Coke system.
I think that on the organic revenue forecast, 4 to 5%, some were looking for at least 5%. So are you conservative? Is there something that's giving you a little bit of caution out there?
I think it's right at the beginning of the year, and I think we've taken a realistic and prudent approach to a number of markets out there, particularly some of the international markets, where we want to see conditions improve, and we need to do some things to execute better. We had a little bit of weakness in the back of last year in India, in China, and a couple of the ASEAN markets. We got plans in place, we've got momentum, we got a lot of things to do, and we're putting those in place and investing for growth. So we want to see those progress through 2026, and of course, in the short term, we've got to offset the tax increase in the Mexican business, which is an important business to us. So I think we've taken a realistic and very prudent approach to the guidance for 2026. But in the end, we're going to continue to invest for growth. If the growth is there, we will chase it and we will invest to get it. And I think what we've just tried to reflect is a kind of a realistic view of what builds the outlook for 26.
How does North America look compared to the rest of the world right now?
Look, North America, the U.S. business had a good year in 2025. In fact, it closed the fourth quarter with 1% volume growth and good, strong revenue growth. Actually, the momentum was building in the back half of the year. So as we go into 26, we think the U.S. business is very well placed. I mean, there is a little bifurcation in the consumer behavior. Those at the higher end are spending on premium, but those at the lower end are looking for affordability and lower price points. But we have the ability with our beverage portfolio and our different packs and channels and price points to really be able to bridge and provide a full offer to everyone. So we think our U.S. business has momentum from 25, and we're encouraged. I think it'll be a strong year in 2026. Of course, with America 250 and the World Cup coming to the U.S., we think we'll have a good year this year in the U.S.
So you haven't seen any real change in consumer spending behavior? I'm asking, we got a weaker retail sales report. We're trying to figure out how the consumer's going into the year.
I think that there's been a little volatility through last year, and I'm sure we'll see that again. You know, January looked a little weaker. Did February look a little stronger? I think there'll be some volatility. There's money coming back into the system, I think, with the April tax refunds. So yes, the bifurcation to some extent across the consumer spectrum will be there. But that just calls on us to deliver the options that work for each bit of the population with the money they got in their pockets. And we're confident we can do it in the U.S. In 2026.
What about these new state aid programs around food, SNAP benefits, that are preventing some from buying soft drinks? How much of an impact does that have? It's a movement that is definitely gaining steam.
Yeah, I think there's going to be a number of states moving on restricting what the SNAP can be spent on. In the end of the day, every consumer that's on SNAP has some SNAP credits and has some cash. And whether it's someone at that point of the spectrum or anyone with more money, at the end of the day, you've got to give them a reason to want to buy your beverages. So we're very focused on delivering choice of different types of beverages, different packages, and different price points. So with the money that they've got, that they can continue to enjoy the beverages that they love. And overall, we think that that'll make it a manageable situation for us in the US and, of course, overall for the total company.
But I mean, this movement, the MAHA movement, the dietary guidelines came out. We've talked a lot about the new food pyramid, but they explicitly warn here Americans for the first time against, we know, highly processed food, but also sugar-sweetened beverages such as soda, fruit drinks, and energy drinks.
Yeah, look, we're very much in favor of gold standard science and a balanced diet. And what we've been focused on at the Coca-Cola Company is really making sure we've got a total portfolio. We are a total beverage company. We have options for people all across the spectrum, whether it's categories from soft drinks, sports drinks, water, ready-to-drink teas, dairy, juice. We have options with sugar, without sugar, with caffeine, without caffeine, with protein, without protein. So if we can provide a full spectrum of choice, we believe we'll be able to do well with the consumers.
And what's working best right now? I mean, is it still the zero sugar Coca-Cola? I also asked because I know the president asked you to roll out the cane sugar Coca-Cola. So what's working out there?
Well, Coke's still working. I mean, Coke is the biggest brand. It's one of the most popular brands, if not the most popular brand, as a trademark with young consumers. What's growing? Coke Zero in the US grew in the fourth quarter in 2025. Diet Coke grew in the fourth quarter in 2025. As you said, we rolled out the cane sugar option, 12-ounce bottle in restaurants, 8-ounce bottle in retail stores. So we believe if we provide choice, we can get the growth with consumers. So you're seeing a lot of growth in the Coke trademark. And of course, we've continued to grow with Fairlife. We've continued to grow with things like sports drinks, where we got Body Armor back to growth. And that's our focus.
Yeah, I mean, Fairlife, it's so great. It has the longest expiration date. It stays fresh for a really long time. So we buy it in my house. James, what's happening with marketing spend? I know you've been using AI more when it comes to generating ads. Does that make you increase your marketing spend or decrease? How are you thinking differently about it right now?
AI, as it relates to the marketing spend, allows us to potentially make the material, make the ads cheaper. Like, we can make them quicker. It costs us less per ad to make. The flip side of that is, with the advent of personalization and media programming and the ability to use AI to do media programming, potentially you can go to different places, and maybe you need more ads, so maybe they're cheaper to make, but you need more of them because you're trying to personalize them. In the end, that's the kind of the back office of marketing, the cost of making the ads. What we really want to see is how much of the money works in the marketplace, whether we're spending it to show ads to people, whether we're doing outdoor advertising, all the way to events. As we talked about, we've got America 250 this year. We've got the FIFA World Cup in the US, Mexico, and Canada. But our marketing spend is across that. So we're looking at the weight of that spend, and we've certainly been increasing that over the years, and we fully expect to increase the amount of working marketing spend we spend in 2026, even if we do end up saving on the back office in the cost about how much it costs to make them.
James, it's kind of an interesting conversation. As a marketer, I wonder whether you think, given some of the suspicion and backlash toward AI content, over time, will there be a premium on marketing content that is not AI? Will the consumer sort of reward that, or are the economics behind it simply too powerful?
I think that the jury is going to be an outfit. I think we might end up seeing the premium being on creative quality. What people are going to ultimately reject is kind of the trash AI stuff, where it's poorly done. or it's poorly imagined and there's no kind of creative delivery in the thing. In the end, the consumer wants the engagement with material that is creatively interesting. Sometimes that can be done with AI, sometimes it needs to be done in a completely different way, even an analog way. Sometimes it's not about the ad, it's about helping people get to the concert or the sports event. But in the end, they want to have an experience, whether it's seeing something or going on being present at something. So I think creative quality, which in the end will be driven by the humans, will be the great differentiator.
Speaking of creative content, how did you react to your iconic, beloved polar bear in the Pepsi ad at the Super Bowl cheating on you with a Pepsi at a Coldplay concert?
Well, it's great to be number one, that people use your iconography to try and help themselves. But of course, if anyone's spending on the cola category, as the market leader by far, we're the number one beneficiary. So that's, I guess, in the end, good for us.
Finally, James, since this is your last quarter as CEO, I mean, how are you thinking about the transition to Enrique Braun? Why now, and what do you expect to be different under his leadership?
Look, Enrique's got the skills, he's got the experience, he's got the vim and the vigor to take us to the next chapter. At the end of the day, the day you announce you're leaving, it's always a day too early until it's a day too late. And I think now's a good time. And I think you should expect a mix of continuity, evolution, and some things that we're going to transform. It was said that the future belongs to the discontented. And Enrique wants to make this business better, a little bit better every single day. And I think that he's the right person to go ahead and lead it.
Well, we certainly hope we'll keep in touch with you, James. Thank you very much for joining us on The Quarter.
Thank you. Great being here.
CEO of Coca-Cola, James Quincy.
Take a look at our roadmap for the rest of the hour. Coming up, Alphabet's rare century bond, what that signals about the health of the market. Evercore's Julian Emanuel will join us to talk about some of the big picture takeaways.
Plus, Paramount's out with what it's calling an enhanced offer this morning for Warner Brothers Discovery. We'll give you the details behind that.
And after the break, a first on CNBC interview with the CEO of Marriott, Tony Capuano. After the company posted a mixed quarter, including some red flags around North American spending. The stock, though, is surging. We'll talk about why. Squawk on the Street. We'll be right back.
Very interesting. Very interesting. Well, we went up, made a new high for today. The 696, was interested in the 696. Got up to it, got my attention, but did not get my money in its place. Beautiful 3-candle reversal. Is it sustainable is the question as we battle for the day. The daily candle being a doji candle right now. State of indecision. Hamza says he likes a call above 695.6 area, put below 693 area. Yes, sir. 693.4. I'm right below you on that. A call has to be watched because of the all-time high. We have no clear top. Yes, sir, buddy. I do agree with you there. Called out the same area above that 696. Like to see a break and retest. That way we will be officially using that 696 as support. Without that, again, at all-time highs, anything could potentially happen, and I'm not excited about joining new money at the 696 without there being a nice pullback and some bears to be used as liquidity and momentum. Not only that, the daily chart right now is showing indecision. The 30-minute chart is showing indecision. The 15-minute chart is just showing basically we are still sideways trading. Any trade that we take this year, we want to ask ourselves, if this trade presented itself 99 times, will we take it all 99 times? If the answer is no, then we leave it alone. And we don't mess with it. Shout out to those of you who are being patient, because patient pays. Patient pays. Let's keep that in mind. Every day is not going to be a trading day. especially when we now want to trade the obvious trades. We want less trades, more size.
Welcome back. More than 30 minutes into the trading session. Here are three earnings movers we're watching. Spotify shares jumping after some strong numbers. Monthly active users grew 11 to more than 750 million. Its biggest quarterly user gain ever and above expectations. Similar story for SoftBank shares, gaining double digits after its telecom arm raised its full-year profit outlook. Analysts also pointing to its large stake in chip designer ARM as a tailwind. And watch some of these luxury names in the green today, led by Gucci owner Kering. Sales beat on the quarter despite some declines year on year, with the company forecasting a return to growth in 26. Shares up 11%.
Wow. Yeah, it was a lot less worse on the Gucci sales. Marriott, speaking of, shares spiking after the hotel giant beat on RevPAR, which is revenue per available rooms for the industry metric, and issued solid 2026 guidance, though it did miss on earnings expectations. Joining us now first on CNBC is Marriott CEO Tony Capuano. Tony, good morning. Welcome.
Hi, Sarah. Good to see you. Thanks for having me.
So I guess that, the street is sort of celebrating a lot in here. The RevPAR numbers, I think the pipeline, the loyalty. How do you describe the environment right now?
I think to state the obvious, there are some economic headwinds, there's some uncertainty, but we continue to see the consumer prioritize spending on travel and experiences, and that really reveals itself in the results that we reported this morning. I heard Carl's comments a moment ago about the performance of some of the luxury groups, and I think luxury was a real highlight for us in the quarter and the year, with luxury RevPAR up globally over 6%.
What about in the U.S., where RevPAR actually declined slightly during the quarter? Is it government shutdown related? What's the story there?
Yeah, we mentioned this on the call. Had the government shutdown impact not happened, we would have been up about a point in the U.S. and Canada. I would say the U.S. business is sort of steady as she goes. We've guided to similar RevPAR volumes in 26, absent the impact of the government shutdown, which had fairly significant impact for about 43 days.
So is it a tale of two travelers now? Is it luxury versus everybody else?
Well, I mean, the K-shaped economy is certainly impacting the travel vertical. Thankfully, we've got about 10% of our global inventory and 10% of our global pipeline in the luxury tier. So we're seeing real benefit from that. But just 3 years ago, we started pushing into the mid-scale space, and we're seeing some real benefit from that more thrifty consumer as well.
Tony, there's been a lot of ink spilled about international inbound into the U.S. Negative last year. Disney referenced it the other day, looking for some headwinds at domestic parks. Are you seeing it? And if you are, like, what are the implications for things like the World Cup?
Yeah, thank you, Carl. It's an interesting question. We are seeing inbound international to the U.S. down. But if you look on a global basis, our cross-border travel across the entirety of the portfolio is ahead of where we were in 2019. This weekend, I had a chance to spend some time with the senior leadership of FIFA, and it was all anecdotal, but the data they shared about the volume of ticket requests and the bookings they've seen, I think bodes quite well for what we'll see through the World Cup.
What about business spending, Tony? What do you see in terms of sentiment and appetite for business travel, events, which makes up such a big part of the business?
Yeah, I think of the three segments we compete in, Sarah, leisure was the clear leader in the quarter and for the year. Group followed that, and then we saw flattish business in business transient. If you look at the negotiations we're having for special corporate business, we expect to see rates up low to mid single digits, which I think is encouraging. But business transient is the softest of the three segments we compete in.
What about the loyalty numbers and the credit card? I mean, some analysts are really impressed with your credit card fee revenue going up, I think 35% or more in the year. What's
it's interesting. It consumed a lot of the call today because you have two factors. We modified the royalty rate that we take into the Marriott P&L, and that was the big pop you saw in today's discussion. We are in the midst, and we mentioned this a quarter ago, of renegotiating our credit card deals with JP Morgan Chase and American Express. We hope to have those deals done this year. There will be some upside from those deals, but we reminded the analysts this morning that those deals will come in on the base of the largest credit card programs of any of our peers. And so we've got to temper the excitement about that, but getting those new deals done will be a nice lift for us.
Tony, we always like to talk about sort of capacity discipline when it comes to hotels. Certainly with unit growth, I mean, would you argue you're putting the pedal to the metal?
Well, we have been for a while, not growth for growth's sake, but we've made such a big bet on our loyalty platform, Bonvoy. And when I get questions about our growth strategy, it's really pretty simple to answer. I want to make sure I have the right product for you anywhere in the world for any trip purpose. And if I succeed in that objective, I keep you within that Bonvoy ecosystem. You don't need to look outside. That's why we got into Marriott Homes and Villas. That's why we launched the Ritz-Carlton Yacht Collection. I want you to find everything you need for your travel needs in that Bonvoy ecosystem. And so our accelerated growth, our record pipeline of over 600,000 rooms, all of that is intended to strengthen that ecosystem.
You talked, Carl asked about FIFA and the World Cup. I know Coke was just talking about it as well. The Olympics right now. I know you guys are a sponsor of the Mercedes team in F1, rival team, it's okay. But how big are these tentpole events in terms of growth drivers for the business at this point?
Yeah, one of the great phenomenons for our business, Sarah, is you're seeing more and more travel tied to these tentpole events. So we mentioned in the call this morning, we expect about 100 basis points of RevPAR lift in the first quarter in Europe, just from the Milan Olympics. We expect similar lift from World Cup. You saw, and I think we discussed a year or two ago, the impact that we saw and the industry saw from the Eras Tour with Taylor Swift. So travel around sports and music events is a really powerful driver.
Is that the rising tide lifts all boats, or are you uniquely positioned?
Well, I think we're uniquely positioned, certainly in terms of the footprint we enjoy in the cities or the regions that are hosting these tentpole events. And as a result, we expect to get a disproportionate share of that demand volume.
All right, well, your stock's up almost 9%. Tony, thank you for coming on. We got to have you back soon to talk about the AI opportunity in hospitality, which is a whole nother segment. But for now, thank you, Tony.
Sure is. Thank you, Sarah.
Tony Capiano, CEO of Marriott.
Meantime, getting some breaking news out of Washington this morning. Let's get to Eamon Javers. Hey, Eamon.
Carl, that's right. Commerce Secretary Howard Lutnick testifying on Capitol Hill this morning, and Lutnick telling lawmakers up on the Hill that, in fact, he did visit Epstein's island. Now, this coming after Lutnick had earlier suggested he broke off all contact with Jeffrey Epstein around 2005. Documents revealed in the Epstein files indicated that, in fact, he had a much more extensive relationship with Jeffrey Epstein after that point in time. And today he's admitting on Capitol Hill that he did go with his family to Jeffrey Epstein's island in 2012. Here's what he said just a few moments ago.
I did have lunch with him as I was on a boat going across on a family vacation. My wife was with me, as were my 4 children and nannies. I had another couple they were there as well with their children, and we had lunch on the island. That is true, for an hour, and we left with all of my children, with my nannies and my wife, all together. We were on family vacation. We were not apart. To suggest there was anything untoward about that in 2012.
So Lutnick saying that nothing inappropriate happened while he was on Jeffrey Epstein's island. Democrats pressing Lutnick, though, said they were concerned that Lutnick had misadvised the American people on exactly what his relationship was with Jeffrey Epstein in his public comments before those Epstein files became public last week, guys. Back over to you.
Yeah, he's also slated to meet with the Japanese trade minister That big $550 billion promise of investment appears to be delayed somewhat, and I think the administration's trying to light a fire under the Japanese. We'll talk more about that later. Eamon Javers. Still to come this morning, why Evercore still sees more market strength ahead, despite some growing AI debt concerns. The firm's head of equity strategy is going to be with us. Got some new reporting on Stripe, the latest tech name eyeing a fundraise and a potential $140 billion valuation, and the latest on the Warner Brothers Discovery saga as Paramount enhances its offer to buy the company. And we're back in a minute.
Welcome back to Squawk on the Street. Time for a CNBC News update. Courtney Reagan has that for us. Courtney.
Hi, David. Good to see you. The heads of ICE, Customs and Border Protection, and the U.S. Citizenship and Immigration Services are testifying this morning before the House Homeland Security Committee. It comes as the Trump administration faces fierce criticism over its immigration crackdown following the shooting deaths of 2 Minneapolis protesters at the hands of federal agents. Meanwhile, a federal judge blocked a California law that banned federal immigration agents from wearing face coverings. The judge said the law discriminated against the federal government because it did not also apply to state authorities, but in the same ruling upheld another California law that requires federal officers to display ID while on duty. And Maine Senator Susan Collins announced today she is seeking a 6th term in a boost to Republicans as Democrats try to flip her seat to take control of the chamber. She has at times clashed with President Trump, who said she should never be elected to office again after she voted with Democrats last month on a war powers resolution that would have curbed his use of military force in Venezuela. Sarah, back to you.
Yeah, she has some tough challengers from the Democrats. Thank you, Courtney.
Thanks.
Courtney Reagan. Still ahead, Evercore's Julian Emanuel with his take on Alphabet's blockbuster 100-year bond offering this week and what he says it could signal for the overall market as the Dow sits at record highs again today. And keep an eye on healthcare after new numbers out of AstraZeneca, Quest Diagnostics, and medical device maker Becton Dickinson all in the pre-market. The stocks are all higher. Don't go anywhere.
As America celebrates its 250th anniversary, CNBC spotlights the companies that rose with the nation and continue to shape its future.
My name's Jamie Heineman. I'm the Chief Technology Officer for John Deere, an American manufacturing company that's been around for nearly 2 centuries. The company was founded in 1837 by John Deere, and it was founded on an innovation, the self-scouring steel plow, that was solving a problem of how to do tillage in the sticky Midwestern soils of the day. The plows of the day were either a wood or a cast iron material, and the soil stuck to those plows. It caused the farmer to have to stop frequently in order to finish the plowing operation. The steel plow solved that problem, allowed for continuous plowing because it was a polished steel surface, and enabled the farmer to plow continuously without having to clean the plow. I think fundamentally, John Deere was about solving a problem for the farmer. He was about creating value for the farmer. That attention to customer is one of these things that still permeates the company today. We think about how can we go create value for our customer base so that they can do the jobs that they do better. Trying to understand how we can take major technology trends that are happening, things like artificial intelligence, and how can you enable a farmer to benefit from that on the farm or the job site? Can we provide them better insights as to what's happening with the data that they're collecting from their farm? What would make John Deere the most proud of the company today is sort of the enduring legacy of quality. And I think connection to the customer, this insatiable desire to understand how can you make the customer's work better, easier, more profitable, and more sustainable. That was the core of his ethos, and he would still see that very much alive today in the company. I think the future's incredibly bright. Technology is making possible things today that were never possible or thought to be possible even 5 years ago, and that's creating opportunities for the farmers and the ecosystem of agriculture.
Alrighty, traders. Looks like we finally getting a break above this 696. Will we get a close above it and a continuation is the question. Big Ben in the building. Good morning to you, buddy. Gonna go with this view for right now, but it's looking like a nothing burger for right now.
Let's get a check on the major averages this morning. Dow record high, got above 50,400 today, off to a strong start in early trading this morning. The S&P less than 0.5% from a record of its own. Julian Emanuel, Senior Managing Director at Evercore ISI, joins us here at Post 9. Talk about how this year has kicked off. I wonder if you're impressed with the ability of other parts of the market to make up for tech drawdowns.
It's definitely a positive, and coming into this year, in a year which we expected there to be a lot of volatility, the flip side of that is volatility is opportunity, and what you typically see to start a new year is the laggards leading, and that's what we're seeing. But frankly, given all the angst around tech valuations, around software in particular, the action as a whole is positive, and even more positive is that we're seeing the stabilization in software.
Do you think old economy growth names are overstating the growth we'll actually get?
It's entirely possible. Some of the valuations in the industrials are very, very high. But again, the message for the market as a whole is if you're going to get that 2.5% growth, and that is our forecast, then everything is really just fine in an environment where we know there's stimulus coming down the pike in terms of the tax rebates from the One Big Beautiful Bill, and more Fed rate cuts coming.
The 100-year bond offering from Google, you see that as some sort of marker of where we are?
So it's very interesting in that respect, and let's face it, the market is digesting this all rather effectively, and the message for us, if you look at the last time, there's a lot of resonance with the late 1990s. The last similar such bond offering was 1997, and the NASDAQ rose 400% between that time in 1997 to the peak in Y2K.
Then it crashed.
Wait, who did that bond offering? Do you remember?
Motorola, right?
Was it? No.
It's Motorola 97.
Was it Motorola?
Yeah.
Oh, look,
yeah.
Good job. Digesting what, though? You just said digesting this. What do you mean?
Digesting the angst around technology coming into this year, and very often we feel more comfortable being contrarian. It was shocking to us that at the start of the year, the contrarian viewpoint was that tech could continue to work.
Yeah, although it didn't work last week if you own any software company.
No, but
and
again,
it hasn't worked all year.
So at the degree, if you look at it, the NASDAQ has really been marking time sideways. Churn in between stocks, the memory stocks on fire, the software stocks tanking. What our work has found is that sometimes when you have a series of crashes like you've had in gold and silver and Bitcoin and software stocks, the leadership, once the stability emerges, tends to be in some of the things that have been out of favor, which is why in our mind this is a very opportune time to be a patient buyer of software in particular.
So you think it is a time to actually step in?
We do.
I mean, you said stabilization. It's been a day, a day. So that's enough?
A day and an hour.
A day and an hour, yeah.
But also, a lot of people read that the bond offering, and now I'm going back and seeing the Motorola. Yes, times were good after that until, Nokia came, and then, it all kind of fell apart.
Well, and look, there could be some point in the future when it's going to fall apart, okay? But when we look at the broader backdrop, the probability of recession is low. The Fed is on our side. There's going to be stimulus. The market's telling you the last month that, if anything, the FOMO's been in gold and silver. That's been wiped away. And
wait, what's been wiped away?
The FOMO around gold and silver.
Gold's up 17%. It's
still above 5K
for the year.
Again, look at where it was several weeks ago. Silver in particular, you hit $120. you're down a third
It's
since
not going
then.
straight up anymore.
No, exactly.
Gold's up 11% for the month. I know silver's gotten hit.
Yeah.
It's down 1% right now.
All right, yeah, but
Not to mention Bitcoin, of course.
Bitcoin is different, yeah. I mean, but all right, so do you want to own any Bitcoin or gold or silver? You don't want to own any of those?
We think for commodities and commodity type themes, there tends to be just sort of a sideways healing process. So we think the best thing that could happen is that both bulls and bears in gold, silver, and Bitcoin get frustrated, and then at some point they will rally again. But that point is later in our mind, after investors fully re-engage with the technology theme.
Are you worried about any sort of trade surprises, or you think the market can deal with that now? Because, we are renegotiating USMCA from a posture that's a little more challenging with Canada here. And some of the ratification of these deals. It looks tricky, and we could see new tariffs.
Well, look, to not think that there are going to be trade surprises and surprises of all sorts would be a serious mistake, because that has been the pattern of the last year. But the market has shown an increasing ability against the backdrop of all of this liquidity to be able to digest those. We're going to find out about the IEEPA ruling at some point. I'm sure that will be a destabilization of a day or two, and then the market is likely to take it in stride as it has.
Finally, savings rate has come down, sentiment's lousy, retail sales today were a goose egg. You think consumption is at risk? All the tax refund story aside?
So this is a bit more of a challenge. There was likely some hesitation on the part of the customer, the consumer, perhaps with the notion that there would be a bump later on. But frankly, it actually isn't a surprise to us, and which is why the market is taking these retail sales numbers as well as it is. Our proprietary Christmas tree survey that we've done every year for the past 20 years showed the weakest year-on-year sales gain in over a decade, and there is some correlation there, so it really isn't a surprise.
Right, that the caution's kind of baked in for now.
Yeah.
Julian, so many interesting storylines, and we're just getting started.
Right.
Good to see you again.
Thank you.
Julian Emanuel.
Still ahead, Paramount enhances its offer for Warner Brothers Discovery. We'll give you some new reporting next. Plus, quick check on shares of Datadog. It's up double digits. Take a look at that, over 14%. A strong quarter driven by demand for its cloud security products. Stay with us.
Grand Rising, Quiet Soul. Team, I'm not liking nothing here. I'll have to look towards the afternoon.
It's been a volatile start to the year for precious metals, but the rally seems to have rebounded, with silver and gold both seeing double-digit growth in 2026. We'll hear from one expert who believes metals will continue to climb and has his eye on gold's next big milestone. Tune in to our Market Navigator segment today on Power Lunch at 2 p.m. Eastern.
Welcome back. Some new developments on the battle for Warner Brothers Discovery this morning. Paramount enhancing its offer for Warner Brothers Discovery, trying to meet any number of the different concerns that the Warner Brothers board had with its offer. And so in so doing, it is now saying, hey, we will fund that $2.8 billion breakup fee. Should you break off the deal with Netflix and you owe them the $2.8 billion, we will fund that separately. So you don't have to worry about that being part of our overall termination fee or coming out of that in some way. We're keeping our $5.8 billion reverse termination fee as well, which would be paid if Paramount is unable to complete the deal. We're also going to deal with the $1.5 billion financing costs that's associated with a debt exchange offer involving your global network spinoff. And they go on from there, saying, and if, by the way, the $15 billion bridge financing that spinoff needs isn't available, we will figure out financing alternatives there as well. And they add a so-called ticking fee. If they're unable to complete the deal by the end of this year, every quarter, the price they pay will go up by 25 cents a share. All of it designed, of course, to get Warner Brothers to the negotiating table, get them talking, and see, in fact, whether they can reach a deal that would then force Warner Brothers to go back to Netflix and say, you need to raise your bid. None of that is clear at this point. The vote right now scheduled for March 12th. That could change, of Warner Brothers shareholders on the Netflix deal. And a lot of it will come back to the value of that global network spinoff. Remember, Netflix is paying $27.75 a share in cash. But the question is, what is the spinoff of all of those cable networks of Warner Brothers Discovery going to be worth? CNN, TNT, and others that are a part of that. And how much debt is going to be on that? Will it be the full $17 billion? And if in fact that's the case, well, what would it really be worth? And by the way, importantly, every amount of debt that moves from that entity back to studio and streaming reduces the overall amount that Netflix is paying. I got into that question with Jerry Cardinal, of course, who is at Redbird, a partner of Paramount on this deal, on the Paramount deal as well originally, and certainly was asking him, well, what are you going to do here if they continue to say the spinoff is worth at least $2 a share? Take a listen. It's possible they'll say the value of that spin is as much as $2 a share, even with the debt load on it. And in part, they might say some of the parts, CNN worth so much more than a multiple of 3.5 times $600 million in EBITDA. TNT worth so much more than that. And so they can easily make an argument it's worth, let's call it $2 a share or more, and therefore it's equivalent. And they say, sorry, guys, we're still not interested.
No, that's not how the math works, okay? They've already said in their most recent filing that, you know, they could see $2 billion move over. So they've already acknowledged that it's over levered, right? And so, you know, the point is this, David. They cannot certify to Warner Brothers shareholders what the value of their deal is. They cannot. It is wholly predicated on where SpinCo ultimately trades, and the capitalization of that SpinCo is what will determine that. You have a comp that simply suggests that it's not going to trade at the levels that they're suggesting. Whatever recapitalization happens at SpinCo adversely affects the cash that goes to Warner Brothers shareholders on studio and streaming.
Key point they're going to continue to make as we move closer to that vote. If they don't get the attention of Warner Brothers board, they simply will be relying in part on things like the proxy advisory firms that make their recommendation to win them over with these latest changes. And maybe you do go into that vote. We'll see. With them saying we have enough on the table that we believe Warner Brothers shareholders will vote down the Netflix deal. By the way, if in fact Warner Brothers believe that to be the case, of course, you might expect that they will go back to Netflix and see if they can somehow firm up that offer. So, Sarah, a lot more to come here as we get within a month of at least the date right now that we have for Warner Brothers shareholders to make a decision.
So is it a better offer or not?
Well, $30 a share, all cash for the entire company with, they claim, more certainty. I haven't even discussed the antitrust reviews ongoing.
That's the ticking fee thing?
Well, a ticking fee would allow them to say, hey, we're willing to take on the risk that this will go longer than we think it will, and we'll give you more money for every quarter you wait for us to get the approvals we need. But the basic contention of Paramount has been all along, we have a much easier road to completion as a result of the antitrust review here in the United States, which, by the way, fairly soon, they've already reached certified compliance with the second request from the antitrust authorities, so here in the United States, and then abroad. And that's the key question, and we simply don't know the answer. Netflix obviously will say, we're going to be fine. We're going to get all the approvals we need.
I don't know. There was a Senate subcommittee hearing that wasn't so good for them on that.
No, you're absolutely right.
I think it's also notable that Paramount didn't feel that they needed to raise their price. Everyone said, oh, they'll raise their price, because they must feel confident that what they're offering is better.
Right. Now, he did not say in any way this is best and final. I did say, well, where's the money from Larry? He said, well, we're already talking B's, not M's, billions, not millions here.
Yeah, true. All right, the saga continues. After the break, new details on the latest private tech company eyeing a fundraise and a staggering $100 billion valuation. B's there too. We'll be right back. Private payments company Stripe The latest tech name eyeing a fundraise and a massive valuation, according to CNBC sources. Let's get to Mackenzie Sagalis with the details. So what do we know, Mackenzie?
Familiar with talks tells me Stripe is lining up a tender offer that would value the company north of $140 billion. Now, that's a 30% jump from its last valuation in September when Stripe bought back shares, and a major rebound from the $50 billion that it was worth during its 2023 fundraise. Now, this tender is a way to give employees and early investors liquidity without an IPO, and that's the key here. Stripe is one of the most closely watched public market candidates in tech, but it keeps finding ways to reward shareholders while staying private. The company has run regular tenders since 2024. It hit full year profitability about 2 years ago, and it hasn't needed outside funding since taking a down round in 2023. In other words, Stripe doesn't need to go public, and this deal suggests it's not planning to anytime soon. Now, it comes as late-stage private valuations keep climbing. Databricks just priced a new round at $134 billion yesterday. OpenAI is in the midst of a pre-IPO mega raise that could hit $100 billion, and the SpaceX xAI tie-up values the combined entity at $1.25 trillion. The Stripe stands out for two reasons. It's the rare private mega cap that isn't an AI company, and it's a no rush to go public. Co-founder John Collison told Bloomberg just last month that they're still not in any rush, even as peers like OpenAI and Anthropic gear up for listings. And Stripe isn't just offering liquidity, it's also putting cash on the balance sheet to work. The company recently acquired stablecoin infrastructure platform Bridge and crypto wallet provider Privy as it leans further into stablecoin-based payments. Guys.
So they're making money too, right? I guess. Judging from everything you just said, it would seem like likely they are.
Yeah, so they finally started prioritizing growth over margins. In 2024, they got to profitability. They've got $2.2 billion in free cash flow, giving it that financial flexibility to lean into M&A.
Matt, good stuff. Nice bridge between the public and the private markets. Got to keep an eye on it. That's from Mackenzie Sagalis. When we come back, Hasbro shares gaining after some strong results. Their CEO is going to join us next, break down the quarter, talk about consumer demand with shares up almost 7% and a decent take. Don't go away.
Good Tuesday morning again. Welcome to Money Movers. I'm Sarah Eisen with Carl Quintanilla live from Post 9 of the New York Stock Exchange. Today, Wizards of the Coast. That is the game that is powering shares of Hasbro higher this morning. CEO will join us with what else he's seeing from the consumer and the economy as that stock sits among the S&P's biggest gainers this morning.
Some rare good news as of late in the software space. Datadog shares surging after quarterly results. We'll dig into that number and a bunch of the other big movers of the morning.
And call it the AI market paradox. In the U.S., every new model taking a bite out of the stock market value. But in China, each new model is a rally catalyst. We'll explore why and just what it means for investors.
As for markets, kind of steadily building over Monday's gains. Got some slight gains for the NASDAQ, Dow, and the S&P. Really only weaknesses in some communication services as Alphabet's down. 10-year did crack below 4.2 on that goose egg on retail sales, which was a disappointment. Begin with some breaking news from the New York Fed. A new report showing the nation's household debt balance has risen to $18.8 trillion. That's a jump of $191 billion in Q4. Balances are up modestly for all categories: mortgages, credit cards, HELOCs, and auto loans. Overall delinquency rates up a little bit, driven by mortgages and more so by student loan debt. Credit card, auto loan, and HELOC delinquency rates were pretty stable. The picture for those with student loan debt does continue to worsen. Outstanding debt now $1.7 trillion, while 9.6% of balances are 90 days or more delinquent. Got some interesting data this week from New York Fed coming off of yesterday.
Yeah, yesterday it was lower inflation expectations, right. Delinquencies higher. It's something we watch, of course, but you know, a little bit weaker retail sales. What happened, and now, is that there's increasing odds of a Fed rate cut. You know, when Kevin Warsh comes in as the next Fed chair, if he gets confirmed, and so. The data, I would also point to actually the employment cost index, which is kind of an inflationary gauge around wages, which also came in a little bit light today. Still solid wage growth, but not as much as we saw the previous time around. So again, maybe buys them more room to cut.
Yeah, although CPI is right around the corner, and you saw JPM Friday last night looking for 0.4, which would bring you back to a 3% annual rate. They think a lot of factors that suppressed inflation in the fourth quarter are starting to come off. And we've talked about the calendar effect. New year, a lot of companies use that as a chance to hike their rates.
Yes, I mean, that's a big wild card. Yeah. Friday, inflation, tomorrow jobs, which is strange. For more on the state of the consumer, the health of the economy, implications for your portfolio, let's bring in Neuberger Berman, Private Wealth Managing Director, Holly Newman-Croft. Always a pleasure. Welcome back.
Great to see you both. Thank you.
So there is a lot of economic data coming in and potential catalysts for this market that now sits. I'm looking at the S&P, 0.4 off the high, about 3% on the NASDAQ off the high. What do you do with all the incoming information?
There's been lots of information in the last week. You know, Friday we had the University of Michigan consumer sentiment number hit a six-month high.
Better, yeah.
Yeah, retail sales today flat, disappointing. We've got some important macro data, as you just said, coming out later this week. I think if we just focus on retail sales, because it's the most timely, what was interesting is the weaker components of the sales number were those areas that were most impacted by tariffs, so electronics, furnishings, cars. They're also discretionary. And when you look at the market performance, it sort of suggests that that would be weaker because consumer staples are outperforming consumer discretionary this year, which is, you know, I like that, a broadening out of performance. But I think overall what we're seeing is a more discerning consumer. They're spending, but they're being more cautious about what they're spending on. And so I think we've got to keep our eye on the consumer. And as you just mentioned, of course, the market is now pricing in 2 cuts this morning after that number up from 1 cut.
Yeah. So do you have you gained more faith in your broadening out trend, which you have been calling for, and that's been so far the story of 26?
It is, and we've seen that, right? So small caps, international, emerging market, energy, materials, consumer staple in the U.S. large cap space. Before the retail sales came out this morning, all stories were about software companies and AI euphoria and how that is all going to play out. So I think there is greater thought to companies in the AI space and who can monetize from it and who will become extinct because of advances in AI. And I think that that there's a lot of rotation out of what has driven this market for the last 3 years, and that will be refreshing. As you mentioned, the companies in emerging markets, there are amazing AI-related technology companies that are so undervalued. And while emerging markets had a phenomenal year last year, it was the first time that it outperformed the U.S. in 15 years. So lots of room to grow, lots of strong companies, and lots of advantages for the investor.
Right. And to your point, non-U.S. equities, third best start to the year since the late 80s? You think this can go on for a while, I assume?
We are overweight emerging market equities, driven by Brazil and India. We think active management is critical because the euphoria of AI moving everything up is over. It's a done story, and it's a much more critical eye to what companies have strong business plans that can justify these CapEx expenditures that we're seeing and ultimately have a pathway to monetizing on them. We talked about this in the small cap space, right? Small cap had a fabulous year last year, driven 90% by non-earning companies. So now we've got to see which companies can actually make money and survive the AI revolution that we are just in the beginning phases of.
One of my favorite charts of the week is the Russell versus the NDX over 1 year. If we had said a year ago that small caps would outperform the NASDAQ 100, I don't think many people would have believed us, right?
They might have turned the channel.
But that's what's happened.
This is what you were saying.
Yeah, and I think that the concern around software, it's not a dead story, and there are a lot of good companies in the small cap space, in emerging markets. What is critical is to find companies that are really embedded in the ecosystems of their clients, so that if AI takes over a part of the business, it doesn't eliminate the need for all of the software. So one-hit wonders, one-part solutions, I'd worry a little bit about that, whereas comprehensive software solutions that become deeply embedded in their clients, they'll just navigate the change in the changing needs of their clients to survive.
Overall, are you betting on a strong, like a cyclical upswing this year? Because that going in, that was sort of the theory, and now people are questioning it.
No, we still see a strong macroeconomic backdrop in a strong market this year. We think the market performance, though, will be made up of different components than the Mag 7, which is made up north of 50% of the performance of the S&P 500 each of the last 3 years. So we are not expecting a recession. We are monitoring the labor market. It's soft, but doesn't appear to fall off a cliff, low hire, low fire. I think the Fed will continue to monitor that as well. But the market and the economy has blossomed really in a higher interest rate, higher inflationary environment for many years. And the focus this year is really going to be on affordability, especially as it's a midterm election year. All the candidates are focused on affordability. The Oval Office is focused on affordability.
Is that good or bad for the market?
Well, it's focused on the consumer, right? And the consumer makes up 2/3 of our GDP. So if we have a strong consumer, that should translate positively.
Okay. Holly, great to get your take, as always. Really
Thanks.
appreciate it, especially on a busy week for data. Holly Newman-Croft from Neuberger Berman.
Thank you.
Let's get to a few of this morning's big earnings movers. For that, we'll turn to Seema Modi covering Datadog, Julia Borston on Spotify. Seema, we'll begin with you. Morning.
Good morning. Big mover this morning. And the first question, Carl, on the earnings call to Datadog CEO Olivier Pomel was on competition from the large language players Anthropic and OpenAI. Pomel, he acknowledged that the LLMs are getting better at mining data, but then made the point that Datadog is in a league of its own when it comes to aggregating complex data, running analysis, detection, resolution before outages materialize. That message seems to be resonating on the street. Shares are surging following that earnings beat. Guidance for 2026, yes, a bit conservative, but still better than the buy side feared, especially when looking at growth X, its biggest customer, which is OpenAI. Now, on that point, Datadog's dependency on OpenAI did come up on the call, to which executives fired back, saying it's diversifying its customer pipeline. It's already working with hyperscalers and the big AI labs. Stock is up about 16%, and as one investor told me, this move does underscore how investors are starting to differentiate, right, between the winners and losers, or in other words, the companies that are working with the large language models versus purely getting displaced by them.
Yeah, something we were just talking about with Holly Newman-Croft. Yeah. Seema, thank you. We'll turn now to Spotify, another double-digit mover. Julia Boorstin with the story. Hi, Julia.
Hey, Sarah. Well, Spotify shares are popping on a top-and-line earnings beat, as well as surging user growth. See, shares are now up about 17%. The company's monthly active users jumped 11% from the year-ago quarter to 751 million. That's 6 million more than anticipated, while paid subscribers grew a better-than-expected 10% to 290 million. The company also guided to better-than-expected user growth, despite hiking prices in the U.S. this month for premium users. Spotify is focusing on the benefit of AI for artists to both make music from scratch as well as monetize their existing catalog, and also to improve users' experience through the likes of AI DJ and playlist tools. Spotify shares are still down about 30% in the past 6 months, but Barclays writing, quote, the major narrative shift that has impacted valuation negatively in recent months is worries about the impact of AI-generated music. The note goes on to say, we believe Spotify is likely to be one of the biggest winners of AI because of its role as a content agnostic distributor, saying we believe this is simply not reflected in the stock. Morgan Stanley saying Spotify is flipping the AI narrative from bear to bull, and they call this the year of raising ambition for Spotify. Carl?
And also a turn of the page on leadership there too, Julia. Thank you, Julia Boorstin. Meantime, Boeing January orders just hitting the tape. Company logged 103 net new orders in January. That's the best January for orders since 2012. Boeing delivered 46 aircraft last month. 37 of those were 737 MAXs. Order backlog now sits at 6,196 aircraft. It's not the best Dow name of the year so far, Sarah, but it's in the top 10.
Yeah, I mean, it's had a great last few months, 25% in 3 months or so, even more than that in a year. Still to come this hour, the stock is up more than 25% this year, and adding to its gains right now, Hasbro. Just out with quarterly results, CEO joins us next with reaction to earnings.
We'll look ahead to this rare Wednesday jobs number tomorrow. Those numbers delayed because of the shutdown. Evercore's Krishna Guha will join us ahead of that release in just a minute.
Welcome back to Money Movers. Take a look at shares of Hasbro, up more than 6% after the company reported a big beat on the top and bottom lines for Q4. Hasbro's Wizards of the Coast game library seeing a sizable jump in sales. Their card game Magic: The Gathering posting its strongest year ever. And Hasbro also announcing today a new multi-year partnership with Warner Brothers Discovery to sell toys and games based on the Harry Potter franchise. Joining us now in a First on CNBC interview is Hasbro CEO Chris Cox. Welcome back. Good to have you. I mean, it's been fun to follow this turnaround story that you've been doing. What do you attribute the strength to? Is it new releases? Is it something with the consumer?
Sarah, first off, thanks for having me back. I think it's kind of all the above. We're doing a really good job attracting new consumers, especially to our flagship franchise, Magic: The Gathering, with our new Universes Beyond strategy. We're doing a great job of bringing on new partnerships. You know, over the last couple months, we've announced K-pop Demon Hunters, Harry Potter, Voltron, Street Fighter, and that's just on toys. Inside of Magic, we have partnerships with Teenage Mutant Ninja Turtles, The Hobbit, Marvel superheroes, and Star Trek. And then we're doing a lot to kind of build new capabilities for Hasbro, whether that's digital games like our upcoming game Warlock and Exodus, AI, and then just continuing momentum on core franchises.
How much of it was holiday demand and the fact that these were very in demand? You know, these were hot games and hot gifts, and then how does that carry over into this year?
Well, certainly for toys, holidays is always important, and we had a really good holiday. From September to the end of December, we grew share in our key categories for 18 out of 20 weeks. But, you know, I think the real growth story for Hasbro is what we're doing on licensing and what we're doing on Magic: The Gathering. And that really is holiday agnostic. Our Magic business is an over $1.7 billion business that grew 59% last year. And we're off to a great start in Q1, so we think that momentum's going to continue.
I was going to say, what are you looking forward to this year in terms of new launches for new products and brands around this franchise and others?
Oh, God, what's not to look forward to? In my job, I'm a bit of a kid in the candy store. I love our new partnerships. I'm really looking forward to the K-pop Demon Hunters product hitting shelves over the coming months. I think Harry Potter is going to be huge. You'll start to see that on January 1st of 2027. You know, I'm a longtime Voltron and Street Fighter fan, so I'm looking forward to those collectibles. And again, Magic is on fire, and I think we have an entertainment slate that's second to none, punctuated by the Walt Disney Company and 4 blockbuster movies: Toy Story 5, Star Wars, The Mandalorian and Grogu, a new Spider-Man film, and at the end of the year, we're going to end on an exclamation point with Marvel's The Avengers: Doomsday.
I was going to say that's a lot of IP coming down the pike through the course of the year. Chris,
sure
you know,
is.
there was a time last year where the only conversation in toys was about tariffs and supply chain. Sounds like margins are bouncing nicely here, and it sounds like to the degree there is a cost impact, it's mostly front loaded.
Yeah, I mean, tariffs were about a $60 to $70 million headwind for us last year, and that was about 2.5 quarters worth of them. So we will have some incremental headwinds from that this year. But I think really the story about Hasbro is about growing where we're tariff resilient. You know, Magic: The Gathering, the vast majority of our product is built right here in the United States for the U.S. market. Our licensing business is basically resilient from tariffs. That's, you know, working with location-based entertainment companies like we do with Peppa Pig theme parks, music partners, entertainment partners. So I think how we're managing with tariffs is smart diversification for our supply chain, and then a mix shift into you know, tariff-resilient categories that come with high ASPs, and really focus on collectors.
What's happening with toy prices as a result of all of this for consumers?
You'd have to go into the data, and it's a little bit mixed. I think you're seeing slight increases in ASPs, but I think that's maybe masking that, you know, some consumers are trading down to more value-oriented toys. So your average revenue per unit is going up a bit, but probably in actuality, you're probably seeing a high single-digit, low double-digit increase in the price of toys overall, with some consumers trading down.
You also talked about how you're deploying AI in everything from supply chain to planning, forecasting. How big of a game changer, pardon the pun, is it for the business?
That's a pretty big one. You know, I look at AI in terms of 3 time horizons. In the short run, it's a huge productivity gain. You know, we think there to be about 1 million man hours or people hours worth of savings this year that we're just going to be able to redeploy into higher value work in the business. You know, less time touching an order, more time touching product and servicing consumers. In the midterm, it's revolutionizing how we design product and how we concept product. In our toy business alone, we're seeing an 80% reduction in the time it takes us to go from something that's hitting the drawing board to something that we 3D print and fully render in real life. And I think that's just going to magnify. And then over the long term, you know, I think AI is going to create whole new product categories and whole new collectibles that are really going to delight and light up consumers. And I think in some cases we can barely imagine what those are going to be, but over the next couple quarters, I think you'll see what Hasbro has dreaming up. And, you know, our focus is going to be on collectors and more of adult-oriented audiences, but I think they're going to be pretty exciting.
Chris, finally, stocks a double over 2 years, and I just wonder whether you're going to use that as a currency, put it to work, think about M&A.
Well, right now the currency that we're putting is into our stock. So we announced $1 billion stock buyback. We still think the stock is a buy. We feel pretty good about what the growth trajectory is for the business. You know, M&A is always on the table, but I think increasingly you're going to see us focus on selective, smart purchases if we go and do it in the collectibles and gaming space, which is really where we see the future of Hasbro.
I remember when you came into this role, having led the Wizards of the Coast franchise and Magic, and we were talking about, you know, how nerdy it was and how that was going to be able to turn around a whole company. But I guess, you know, we see it in the results now, Chris. Thank you for joining us.
Sarah, Carl, thanks so much.
Appreciate it. Chris Cox, the CEO of Hasbro.
When we come back, it's outperforming the S&P financials by a wide margin to start the year. We'll talk to the CEO of Key Corp, investors focused on expenses, of course, and tech spend.
Plus, we'll get to this move in shares of Ferrari. Some new models expected to help boost margins. Stock up almost 10%. And watching BP under pressure after suspending its share buyback plan, the board deciding to use the cash to, quote, accelerate strengthening its balance sheet. Stay with us.
Welcome back. A number of high-profile bank executives on the tape today with conference season now in full swing. Our Leslie Picker's back at Post 9 with some of the high-profile interviews this morning and joins us to talk about it. Hey, LP.
Hey, Carl. Yeah, we just actually interviewed KeyCorp CEO Chris Gorman, who's attending that BofA Financial Services conference in Miami. We spoke after the news broke that the activist holdco decided not to pursue a proxy fight at the Cleveland-based lender.
There's nothing about yesterday's announcement that surprised us. As I said before, we're really aligned with the investor as it relates to return of capital, as it relates to focusing on organic growth. We think we've got a great organic growth opportunity in front of us, and that's really what we're focused on.
At issue in that activist fight was Gorman's disinterest in M&A to grow KeyCorp, despite many of his peers opting to consolidate. Gorman remains steadfast that he thinks it's better for KeyCorp to grow organically.
I think the environment is probably as good as I've seen it for a long, long time. I mean, we're able to reach out and to hire people. As I said, we have plenty of capital. I think as I look down the road, I think AI is going to be a great opportunity for regional banks. Some of the concerns out there, I think, could be, to the extent there's a credit correction, to the extent there's excessive competition for deposits, but we're not seeing either of those right now.
We've also heard from two of the biggest private credit players this morning, Ares and Blue Owl, which also spoke at that BofA conference. Ares CEO Michael Arrighetti addressed the recent volatility around software disruption.
It is quite odd to us that the public markets have woken up to AI disruption as a theme. If you've been investing over the last 5+ years and you haven't been thinking about opportunities and risks created from technology and AI implementation, you've probably been asleep at the switch.
Blue Owl's Doug Ostrover spoke about digital infrastructure, saying he remains incredibly bullish on that space, guys.
I was just looking at year-to-date KRE versus the XLF, and I wonder what accounts for the regional strength. Is it about M&A optionality or something else?
I think it could be a bit of a catch-up trade because they've been underperforming over the last few years. And one of the interesting aspects of the conversation I had with Chris Gorman of KeyCorp was this idea of, here we are almost 3 years post Silicon Valley Bank. There are a lot of questions about, the current environment and what it means for regionals, whether it, relates to deposit competitions, which of course the big banks have been pretty aggressive on that front, at least in terms of opening banks and trying to garner more deposits. And he said, look, we are not seeing major issues on that front. We've actually grown our deposit base 7% over that period of time, and that the place and the necessity of community banks remains strong, of super regional banks remains strong.
What do you make of all the pushback from the private credit companies? I mean, it feels like a mix of defensive and promotional and a little bit of straight talk. I don't know. What do you think?
I mean, it's pretty interesting. Yesterday, we heard from Apollo, and they gave some numbers in terms of their estimates of where they see the software exposure, which was higher than any of the estimates I had seen. That it was, I believe, Mark Rowan said that it was about 30% of private equity deployment and 40% of private credit. I may have reversed those statistics off the top of my head, but either way, it's pretty big in number. And the reason for that is because software over the past 10 years or so has been seen as an attractive asset for private equity and private credit as the financing mechanism for that, because software, the business model is such that you have a recurring revenue, it's easy to predict, therefore it's easy to finance, and that's what's really attracted this cohort into the space. Now, their defense is that, look, software is a big exposure here, but not all software is monogamous. There is software that is pivoting toward AI and will not be disintermediated. There's software that, of course, may see some serious disintermediation as a result of AI. And of course, the market is treating this all as kind of one thing. At least that's according to the private credit managers. Now, it remains to be seen. The market is very quick, as we've seen, to react and sell off the private credit managers. We saw that with the cockroaches in the fall, and we're seeing it now with software. Whether any of it has staying power is, I think, something that remains to be seen.
Okay, Leslie, thank you. Leslie Picker. Time now for a news update. Courtney Reagan has it for us. Morning, Courtney.
Hi, good morning, Sarah. The FBI says its agents in Tucson continue to work around the clock to locate Today Show host Savannah Guthrie's mother, Nancy, but that they are not aware of any continued communications between the Guthrie family and the suspected kidnappers. and have still yet to identify a suspect or person of interest. The 84-year-old has been missing now for 10 days. The Trump administration is reportedly preparing for a big change in U.S. climate policy. The Wall Street Journal says the administration is getting ready to repeal the government's scientific finding from 2009 that 6 greenhouse gases are a threat to public health in the U.S. The finding paved the way for stricter vehicle fuel economy standards under the Clean Air Act. And shares of Hyundai were up 6% and sold today after its robotics unit, Boston Dynamics, released this video of its Atlas humanoid robot sticking the landing after attempting a cartwheel and a backflip. Look at that. Hyundai unveiled the robots last month at the Consumer Electronics Show in Las Vegas and said it plans to put them to work in its factories by 2028. It's pretty impressive, but can it do factory work too?
I don't know. I can do that.
Yeah. Yeah?
Thank you, Courtney.
Okay, I'd love to see it.
I can do a cartwheel at least.
A cartwheel, okay. Yeah.
The flip part, maybe not. I used to. Thank you, Courtney.
Thanks, Sarah.
Courtney Reagan. Still ahead, several high-profile earnings this morning, helping to paint the picture of the U.S. consumer. We're going to have more on what the CEOs of Coca-Cola and Marriott told us just a few moments ago.
It is a big week for economic data. We'll look ahead to some of the key numbers investors still need to look out for, including this rare Wednesday jobs number coming out tomorrow.
Welcome back. Coca-Cola and Marriott both out with results this morning. The common theme, more cost-conscious consumer. Coca-Cola missing revenue expectations for the first time in 5 years, although noting demand is improving, and he suggested it was a lot of one-offs. Meanwhile, Marriott seeing weaker travel spend by low and middle-income households, and another example of what they call the K-shaped economy. Revenue for the luxury segment grew, both domestically and abroad. We got a chance to speak with both CEOs last hour about what they're seeing from the consumer. Listen.
There is a little bifurcation in the consumer behavior. Those at the higher end are spending on premium, but those at the lower end are looking for affordability and lower price points. There's been a little volatility through last year, and I'm sure we'll see that again. You know, January looked a little weaker, did February look a little stronger? I think there'll be some volatility. There's money coming back into the system, I think, with the April tax refunds. So yes, the bifurcation to some extent across the consumer spectrum will be there, but that just calls on us to deliver the options that work for each bit of the population with the money they got in their pockets, and we're confident we can do it in the US in 2026.
To state the obvious, there are some economic headwinds, there's some uncertainty, but we continue to see the consumer prioritize spending on travel and experiences, and that really reveals itself in the results that we reported this morning. The K-shaped economy is certainly impacting the travel vertical. Thankfully, we've got about 10% of our global inventory and 10% of our global pipeline in the luxury tier, so we're seeing real benefit from that. But just 3 years ago, we started pushing into the mid-scale space, and we're seeing some real benefit from that more thrifty consumer as well.
All right, Marriott, one of the top gainers on the S&P right now. Overall, Carl, it feels like a continuation of the trend on the K-shaped economy where luxury is outperforming and lower income has underperformed. That's not really new. We've been hearing consumer CEOs talk about this for quarters now. Overall, though, it's still pretty solid consumer spending growth. And, you know, they talk about some of the headwinds and volatility, but overall, pretty good macroeconomic environment, I would say, from both of these reads. And Hasbro, too, who we just spoke to, is also at the top of the market today.
Yeah, definitely doesn't really rhyme with the retail sales trend or certainly the delinquency trends that we'll talk about with Krishna in a moment. But that Marriott chart doesn't lie. I mean, that's a chart that suggests some confidence on Marriott.
Well, look, I mean, they're getting these higher prices and higher occupancies on the luxury side, and that's driving a lot of the business as well. Leisure overall, I think, is in a healthy place. And they both actually, CEOs, Coke and Marriott, talked about the World Cup as catalysts. I mean, these sort of event-driven experiences, which have become so much more ingrained in what we do. And they become really important for companies like this.
Got a Swift Eras Tour reference in there, too.
That was Marriott. It was a big winner for that. And the Olympics, too.
Right. For more on the economy ahead of the jobs number tomorrow, let's bring in Evercore ISI Vice Chairman Krishna Guha. Krishna, also the head of economics and central bank strategy at Evercore. Krishna, it's great to have you back. Thanks for the time.
Anytime.
The range on tomorrow's number is kind of wide. There's actually a couple calls for a negative print. I wonder if the revisions might be. Do you think there's risk tomorrow?
So this is one of the numbers where estimates are all over the place, and frankly, with some good reason. It's been hard to get a read of exactly where the labor data is going to come out through the adjustments following out of the shutdown, along with the basic uncertainty around the economy. Also, of course, there's these benchmark revisions and many other things. But I think when we try to look through some of the noise here, the basic point is that the underlying growth rate of the U.S. labor force has stepped down very substantially. And so the kind of number that would have looked quite weak in the past, say 30, 40, 50,000, would be an okay read. And, you know, a mildly negative number would not be catastrophic. And it's the kind of thing that we might have to get used to from time to time going forward.
Right. That's definitely been the administration's spin. It seems like they're trying to maybe soften up expectations in advance of the number. Still, though, we'll watch the unemployment rate, and we do know that illegals, as they've been deported, don't collect unemployment.
Yeah, so look, we think that there's a risk the unemployment rate edges up a tenth in this coming employment report. You know, the labor market does tend to lag economic activity, even under normal conditions. And there seems to be a weaker relationship right now between growth and employment than normally prevails. Part of that is the uncertainty you talked about. Part of that, we think, may also be some secular AI-related effects on the labor market. So unemployment could still edge up a bit. Nonetheless, we do expect the labor market will gradually stabilize over the coming months.
Yeah, there's been some attempts to explain away, for example, the rise in unemployment among recent college grads. The general thinking is that it's more about labor turnover, which has declined so much, and when that happens, it's bad news for the new entrants. How convinced are you that AI has something to do with it?
So I think it's not 1-0, right? It's not a binary question. You're absolutely right that the difficulty newly qualified graduates have in finding jobs is part of a larger phenomenon where there's just been very little turnover, very little churn in the labor market, low hiring, low firing equilibrium. And of course, that means anybody who's trying to find a job is struggling. That includes the relatively small number of people who lose their job, but then find it extremely difficult to find a new one. So in that sense, there's nothing completely, unique or technology driven about what's happening to the new graduates. But I think some of the careful work on this suggests that the spread between newly qualified graduate unemployment rates and unemployment rates of other cohorts is somewhat unusual at the moment. And that is probably some indication there of an AI-related effect on top of the general low hiring phenomenon.
I mean, yes. And the other thing that I've been trying to point out is that wages are still growing faster than inflation. They've come down a little bit, but I mean, the employment cost index today showed wages and salaries were 3.3% in the quarter. They were 3.5% in the third quarter. I mean, that's still solid wage growth. So if it was really all about labor demand, you wouldn't be seeing that.
Yeah, I mean, look, you're right. I would describe the current wage rate as moderate, but certainly, it is generating, real income growth net of inflation. Not a lot. It's low, it's low real income gains. And of course, the number of jobs being added is very low now. And so if you think the growth of consumer spending power on the labor income side is the real income gain, plus the extra number of jobs, that is quite weak right now. And of course, one of the things going on here is, immigrants are consumers too, right? So for the same reason that low growth in the immigrant workforce is contributing to these low break-even rates of job creation, that is also subtracting from the normal rates of consumer spending growth. But just quickly on that ECI print, one thing that we think is really important is to note that wages, as measured by ECI or AHE, are growing less than productivity at the moment. That means unit labor costs are growing by less than 2%, the Fed's inflation target. That should give you a lot of confidence that when the tariff inflation eventually rolls over, say around mid of the year, we're going to reveal a benign underlying inflation story that supports Fed rate cuts.
Finally, Krishna, we just got that news. Share of U.S. loans and delinquency now the highest since 17. Share of student loans in serious delinquency, that's an all-time high. I wonder if you pair that with this retail sales number and suggest that maybe we're in for more weakness than we expect.
So I think we're certainly getting confirmation that the consumer in aggregate, as you pointed out, it's really the low to middle end consumer, came through the turn of the year, in fairly weak shape, nothing catastrophic, but, feeling the strain. That's reflected in the delinquencies, that's reflected in shopping for bargains, it's reflected in, the softer retail sales relative to expectations. We do think this should firm up some as tax refunds start working their way into the system and the economy continues to grow at an above trend pace, driven by business investment more than a surge in consumption. But we need to keep an eye on the consumer complex. The low middle end is still the weak point in this economy.
All right. Next time we'll talk some SCOTUS and IEPA. You guys have been doing such good work on that front, Krishna. Thank you, as always, Krishna Guha.
Speaking of the luxury consumer, Ferrari is one of this morning's biggest winners. We'll take a look at what's driving the move in that stock when Money Movers comes right back. Welcome back. Big move for Ferrari this morning. Robert Frank has more on the quarter. What did they say, Robert?
Well, Sarah, those shares up 10% so far today. It's the best day for those shares in 2 years. Revenue and profits topping expectations. This was a big sigh of relief for investors after October. You might remember that's when the stock dropped over 20% on that lower revenue guidance through 2030. This latest quarter, revenue was up 7%, margins up to 30%. Now, they only produced 13,600 cars last year, but their profits are now growing from higher priced cars and more personalization, specifically customers asking for a lot more carbon fiber finishes. Now, CEO Benedetto Vigna pushing back on the Wall Street's desire for more volume growth, saying, quote, Ferrari is not a volume business. When a client owns a Ferrari, they want to be sure that not too many people also have one. Now, the falling dollar also highlighted this morning the company projecting $200 million euro headwind from currencies this year. Ferrari planning to unveil its first electric Ferrari in May. It's going to be called the Luce. That's Italian for light. And they revealed the interior yesterday. By the way, it was designed by Johnny Ive. Of course, he's the former Apple design chief. No word yet on the price or number of EVs they plan to build. But Vigna is saying they will be highly selective in choosing the customers who will get to buy the car, saying it will only be sold to people who really love it and want it. And guys, we're going to have to see how many people want an electric Ferrari and buy one, but a very strong quarter to end the year last year for Ferrari, sending those shares up this morning.
I like the way you use the words choosing the customers who will get to have the car. That kind of points to the backlog that has been part of the Ferrari story for a while, right, Robert?
Yeah, they're sold out through the end of 2027. So this is the kind of company where there's such a long backlog that even if they have some ups and downs in China or other markets, they're fine. They've got that cushion for the next 2 years, really, of already sold cars.
Yeah, stock's been challenged for a couple of years here. We'll watch that closely. Definitely not your everyday auto stock. Robert, thanks. Robert Frank on Ferrari. When we come back, U.S. and Chinese markets having very different reactions to the latest AI announcements. We'll look at that paradox as Money Movers continues.
أشرقت نفسي بنور من فؤادي حينما رددت يا رب العباد وانتشت روحي وصار الدمع يجري يا إلهي خذ بقلبي للرشاد أشرقت نفسي بنور من فؤادي حينما رددت يا رب العباد وانتشت روحي وصار الدمع يجري يا إلهي خذ بقلبي للرشاد أشرقت نفسي بنور من فؤادي حينما رددت يا رب العباد وانتشت روحي وصار الدمع يجري يا إلهي خذ بقلبي للرشاد في سكون الليل أدعو في سجودي والدجى حولي سواد في سوادي يا رؤوفا يا رحيما يا حليما يا كريما ما لفضلك من نفادي يا سميعا يا مجيبا يا عظيما اهدني يا خالق السبع الشهاد أشرقت نفسي بنور من فؤادي حينما رددت يا رب العباد وانتشت روحي وصار الدمع يجري يا إلهي خذ بقلبي للرشاد أشرقت نفسي بنور من فؤادي حينما رددت يا رب العباد وانتشت روحي وصار الدمع يجري يا إلهي خذ بقلبي للرشاد للهدى والحق وفقني إلهي فعلى توفيقك اليوم اعتمادي يا إله الكون يا عوني وغوثي يا ملل الخلق في يوم المعاد أنا يا ربي أرجو منك عفوا فاعف عن ذنبي وحقق لي مرادي نفسي بنور من فؤادي حينما رددت يا رب العباد وانتشت روحي وصار الدمع يجري يا إلهي خذ بقلبي للرشاد أشرقت نفسي بنور من فؤادي حينما رددت يا رب العباد وانتشت روحي وصار الدمع يجري